So let's talk next about the life insurance topic.
Well, in my book here, the New Retirement Savings Time Bomb, I have a whole chapter on this. Even though I don't sell life insurance, I want to make that clear. I'm a CPA, a tax advisor. But as a tax advisor, I have to tell you, the tax benefits, the tax exemptions for life insurance are among the single biggest benefits in the tax code and not used nearly enough. I call my chapter on life insurance the power of life insurance. Why? Because it's like a super Roth. If you ask me, you can put more money into it if you have the right advisor. And I would only do this with an insurance professional who knows how to set these things up. But it's basically a permanent, not a term life, a permanent whole life policy that builds cash value that has a double benefit. You can use it during life as maybe a substitute retirement plan. If you need money during life, you want to pull it out of the policy, which you can do in certain policies. They can also have long-term care riders. I have this myself. I love the hybrid life insurance policy. I switched to that about 5 years ago, maybe longer, 6 years ago, when they started becoming popular. I found it was a much better choice to plan for long-term care through my life insurance buildup. And this way I didn't have to worry about paying thousands of dollars every month for a long-term care policy that may or may not pay off. I don't know if you ever read these things, but you never know if it's going to pay off. With this, if there's a problem, if I need long-term care, I could, in essence, draw down from my life insurance while I'm alive. Will my beneficiaries get less if I do that? Yes, but who cares about them? They're going to get plenty anyway. This is about taking care of yourself so it has lifetime benefits, and then hopefully, if you never need it, it's the tax-free windfall and the leverage tax-free. In other words, they're going to get a lot more money, and all of it tax-free. And life insurance, unlike that Roth IRA I just talked about, can be estate tax-free. A Roth IRA is never estate tax-free.
No, fantastic. And life insurance is so much better for long-term care, in my opinion, because long-term care, they can raise the premium.
Right. I love the policy I have, and it's a great thing. I switched over all my insurance, like I said, about 6 years ago, when I realized that these policies were available. And they were kind of new then, but I think it's getting out there. I don't know if they're in every state yet, but I see there, you may know better than me, but I think it's getting out there. And most of the articles I read in financial journals, unbiased, like I see it in Kiplinger's, Wall Street Journal, they say, this is the way to cover yourself with long-term care through the buildup in your life insurance policy, which builds tax-free, like a Roth IRA.
Yeah, and you can get some insurance policies that don't have rising costs so that you're protected that way. So when we return, we'll talk more about life insurance as a potential retirement savings vehicle, but predominantly it's insurance. So you want to be careful about that as one of the best tax benefits in the tax code. And we'll talk about Roth. So when we return, this is Josh Jolinski, the financial quarterback. Don't touch that dial. And we're back with Ed Slott, best-selling author. And folks, if you want the book, you get it free when you schedule and keep your no obligation review at 888-988-JOSH. This is one of the hardest shows to do in the middle of a beach house. Whoever made beach houses, back in the day made them so unfunctioning. The office of this beach house is literally like open air. So you can hear my kids screaming in the background. It's wonderful. So I'm trying to mute them as they come on. So Ed, you talked about Roths. You talked about life insurance. What else do you like life insurance? What about people say, you hear talking heads say, life insurance is a ripoff. What do you say to that? Or it's not worth doing?
Not when you need the money, when that big payout comes. I never heard anybody complain, especially a beneficiary. What's this $5 million check? Oh, it's tax-free too? Who needs that? I never heard anybody ever complain. In fact, the complaint I hear most from people with life insurance is always, as they get older or sicker, I should have gotten more. I don't have enough, because they see more needs to be protected. Their estates are growing, and Everybody who has it wishes they had more, including me, by the way. And I thought I had plenty. But I want to give you the, I talked all about a life insurance, but I didn't talk about the IRA connection. How do you move IRAs into life insurance? Well, you can't. It's similar like a Roth conversion. You take the money out of the IRA. Remember, we want to get rid of that ticking tax time bomb. We take it down at today's low rates and we build up. We use that money after the tax is paid to purchase the life insurance policy, which will pay out, in my opinion, a lot better for beneficiaries. It's income tax free. It can be set up to be estate tax free outside of the estate. Plus, you have the ability to withdraw from it either for long-term care or just regular living expenses for most permanent policies. So you're covered during life. One of the things I always tell consumer groups, I always throw out a question because they can't understand that it's such a versatile, flexible vehicle. I said, can you be the beneficiary of your own life insurance without dying? And they look at you like, what? Wait, what did you say? Can you be the beneficiary of your own life insurance without dying? And the answer is yes, by drawing out some of that cash value if you need it. But if you can use that money, same thing like with Roth, because they're both tax-free, you can control your tax bills. See, what you're doing, what I talked about with the Roth, and same thing with the life insurance, you're bringing down your taxable savings and bringing up your tax-free. And if you took it to the extreme, and I'm not saying to do that, let's say you emptied out your whole IRA and you have it all in Roths or a life insurance. I'm not saying to do that. Moderation is good with everything, and everybody's situation is different. But just to give an extreme example, if you had no IRAs, then you don't have any required minimum distributions at age 72, and your tax bill is going to be very low. So every time you do what I say, you're actually saving current taxes in the future, because the lower your IRA balance goes, the more you bring it down, the less your required distributions will be, the less income you'll have, and the less taxes you'll pay, while at the same time, your Roth IRA or the cash value in your permanent life insurance policy is building 100% for you and your beneficiaries. That's where you want to be.
And your Medicare premiums are lower,
right,
too.
Anything triggered to your level of income. So not only will your taxable income be lower, as you said, Josh, those Medicare Parts B and D premiums, which go up as your income goes up, the Social Security, anything tied to your income. If your IRA money is lower, you'll save money there. All of these things we call stealth taxes, because you don't see them coming. So you can save money, additional money there. Now, the flip side is if you're watching or listening to this and you say, nah, I'll just not do anything. Well, that's an option, but it doesn't mean the problem goes away. It's like the sign in my dentist's office: ignore your teeth and they'll go away. It doesn't go away. It just builds. It builds. Let's say you do nothing. You just watch your IRA grow. Well, at 72, you'll be forced to take it out at whatever the prevailing tax rate is. And if it bumps you into a higher bracket, you're going to have less. Your standard of living may be impacted. Other taxes like the Medicare charges and everything else, it's all going to hit. So I'm talking about using the IRA. That money's going to be taxed anyway. It's not if, but when. If you can knock that bill down now and start building up in your tax-free Roths or life insurance, you and your family will have more and more of it tax-free when you need it the most, in retirement and to pass on to your loved ones.
Fantastic. And one way, another way to say what you were saying earlier about the life insurance is the number one beneficiary in a life insurance policy is you, the buyer of the life insurance.
Right.
Meaning, let's say you love your kids, but you don't love them that much. You want to enjoy more of your money. And I do want to talk about that next segment, because you've been talking about that a lot over the years. And I think actually we have to take our final break of the hour anyway. So we'll leave that as a cliffhanger. We'll talk about enjoying your retirement years. But what I was going to say is the number one beneficiary in a life insurance policy is you. And if you really, let's say you don't want to leave them that much, you know what you could do? You could spend your money, right? You just spend it all. And whatever you want to leave them, you could buy $1 million life insurance policy, you could buy $500,000, you could buy $2 million, whatever you want to leave that in the life insurance and just spend your assets. Spend it till the end.
Right.
Let the last check bounce on the way as the undertaker pulls away, and then that'll be replenished with a life insurance policy. I want your take on that when we return, and how so many people are not truly enjoying their money in their golden years, partly because maybe they haven't heard about your strategy. So folks, go to IRAhelp.com. That's Ed's website. Buy his new book, The New Retirement Savings Time Bomb. And if you want it free, call us for your 45-minute ultimate financial game plan. 888-988-JOSH, 888-988-JOSH.
The preceding program was sponsored by the Jelensky Advisory Group.
Any awards, rankings, or recognition by unaffiliated third parties or publications, including 5-Star Wealth Manager, Advisory of the Year finalist by Senior Market Advisor, and top of the $1 Million Roundtable, are in no way indicative of the advisor's future performance or any individual client's investment success. No award, ranking, or recognition should be construed as a current or past endorsement of Josh Jelensky or Wealth Quarterback LLC. Information regarding specific awards, rankings, or recognitions is available on the Wealth Quarterback website at www.jelensky.org. All investment strategies have the potential for profit or loss. Investment strategies such as asset allocation, diversification, or rebalancing do not assure or guarantee better performance and cannot eliminate the risk of investment losses. There are no guarantees that a portfolio employing these or any other strategy will outperform a portfolio that does not engage in such strategies. This broadcast should not be construed by any client or prospective client as a solicitation to effect or attempt to effect transactions in securities or the rendering of personalized investment advice. Due to various factors, including changing market conditions, the information discussed in this broadcast may no longer be reflective of current positions or recommendations. While information presented is believed to be factual and up to date, Josh Jelensky and Wealth Quarterback do not guarantee its accuracy, and it should not be regarded as a complete analysis of the subjects discussed. The tax and estate planning information discussed is general in nature, is provided for informational purposes only, and should not be construed as legal or tax advice. Listeners should consult an attorney or tax professional regarding their specific legal or tax situation. Advisory services offered through Wealth Quarterback LLC.